Good morning, good afternoon, and good evening, everyone. I'm Shumia Ouyang from Oxford Side Business School, and today we are very happy to have Professor Matthieu Bouvard here to present the paper Lending and Monitoring Big Tech versus Banks. This paper is of great relevance to today's economy when the technology is rapidly shaping the financial landscape. And so the webinar will last for 1 hour, and please unmute yourself and ask questions whenever you have some. And welcome, Matthew, and the floor is yours.
Thanks much, Shimo. Many thanks to all of you for attending this. So as Shumia was just saying, don't hesitate to jump in if you have questions. I think it's going to make this more lively. I'm also curious about your reactions to this paper. So this is joint work with Catherine Casamata, who's also here at TSC in Toulouse, and then Hui Zhong, who's a PhD student also in Toulouse and actually also in the audience. So she's going to handle the tough questions. Okay, so let me try to motivate a bit what we're doing here, even though I think with this audience, maybe that's not even useful. So we're really interested in the notion of credit being provided by big tech. So this is, the typical slide for a theory person, which is like slightly outdated data. But the idea here is to say, okay, so if you think about how financial services are changing, I mean, clearly there's more and more credits being provided. So this is aggregated data from around the world. So there's a lot of different contexts there. But essentially, the idea is that this notion that, this fintech, broadly speaking, players are more and more active. But now, what I like about this graph is that it does make this distinction between fintech and big tech. And the distinction is essentially fintech is a pure player. So fintech would be something that, or an entity which looks a bit like a bank, at least fulfills some of the functions of banks, but is a pure financial service provider, right? So it's not a company which is going to be active in other kind of services. Opposed to big tech, where big tech would be firms which are actually primarily active in different type of services, for instance, as e-commerce platforms that connect buyers and sellers, and then enter the credit market from this base that they have from their main activity. And what this graph seems to be saying is that, if anything, the dynamic seems to be more on the side of these big tech platforms than on the side of fintech. And so seems like, so in a natural question for us, so again, we're coming at this question from a theory point of view, is to say, okay, so why is it that we see the growth of big tech, of credits from these big tech firms? So one thing I should have actually said earlier is that what we're going to be really focusing on here is credit to, so provided by big tech, but we're going to focus on the merchant side of this platform. So these platforms connect merchants and buyers. What we're going to be interested in is why does it make sense for a big tech platform, for an e-commerce platform, to provide credit to merchants? So there are theories already out there which are trying to explain why we see this entry. So oh, sorry, I thought that was a question. So the theories which are already present out there, so actually there are more theories than what I just showed on this slide. Let me just point out two things. So why is it that we see this entry? First idea is that so big tech enter the credit market because they're more efficient than banks. And then, so you can think of these efficiencies along two dimensions. If you think of the kind of the decision to provide credit, there's kind of this ex-ante screening and this ex-post monitoring. So ex-ante screening would be to determine is this borrower creditworthy or not. One argument is that maybe big tech has access to data that banks don't have access to, or maybe they're just better equipped to analyze this data and to map this data into a measure of credit risk than banks are. Or it could have to do with what happens once a loan has been granted. And the idea is that these big tech platforms have a better ability to enforce the repayment of the loan. One idea here is that, for instance, if you're an e-commerce platform like Amazon, so one of the things you can do is that you can have a loan which is structured in such a way that anytime a merchant sells something on your platform, part of the proceeds from this sale actually automatically goes to repaying the loan. And that would give you maybe like a better ability to enforce repayments than the banks. So I managed to do at least 2 papers out there which kind of build on these ideas that platforms are more efficient. Another even simpler idea is that maybe it's just a regulatory arbitrage. So banks face some constraints that maybe some of these platforms don't. And that's just explain why they would want to enter. So just to be clear, what we're doing here is we're not trying to dismiss any of these explanations. We're not saying that this is not going on. We're just taking a slightly different angle on this question. So the question we ask is, on top of any advantage that these big tech platforms may or may not have over traditional banks, is it also the case that they have different incentives to enter the credit market? That because they're not banks, but they have this kind of main line of business, which is distinct from financial services, would that potentially affect the benefit that they get from entering this credit market? And so there's a simple idea here, which is in part correct and in part incorrect, something that we're going to discuss maybe during the presentation. But the simple idea is that, so one difference between a bank or even a fintech and a big tech is that if I'm a bank and I provide a loan, I should make this decision primarily based on what I think the cash flows from these loans are going to be, right? So what I'm interested in is really, I'm giving you a certain amount of money. What is the likelihood that you're going to give me this money back over time and, with some kind of some risk exposure? But the decision in some sense is purely financial. If I'm actually also active as an e-commerce platform and I provide a loan to a merchant, of course, I'm going to still care about repayment and default, but there's going to be a side effect to me providing this loan to this merchant, which is that you might actually allow this merchant to sell on my platform. And if this merchant sells on my platform, then it actually might generate revenues for me through that activity. And if you also think that you have typically externalities on platforms, so the more sellers or buyers you have joining the platform, the more attractive it is for other sellers and buyers to join. You can also have these indirect network externalities, which give you this extra incentive to provide credit. So that's kind of, I think, where actually initially we started from. That was our initial intuition. As you'll see, there's a caveat to this intuition, which is that, yes, platforms are going to care about attracting sellers and buyers. Yes, they care about network effects, but they already have an instrument to kind of regulate this part, which is the price, right? So it's going to charge a certain fee to merchants, potentially to consumers. And that actually already allows them to decide, how much of the demands they want to capture on both sides of the platform. So if you want to argue that, credit is something that gives them an additional dimension along which they can play, you really have to pinpoint why is it exactly that the price that they charge directly on the platform is not enough? Why is it that they need this extra instrument? And so this question is kind of motivates how we're going to think from a theory point of view, how we're going to design the model that I'm going to show you next, right? So what we really want to have is a model in which we can think jointly about the core business of these platforms in some sense, and how they're going to decide on pricing, both on the merchant side and on the buyer side, on the consumer side. And at the same time, they're going to have the option to lend, and they're going to make a price decision, or actually more than a price decision. They're going to just think about how to optimally design a contract. And we really want to be able to see how these kind of two dimensions, pricing on the platform and lending, how they interact. So that's the general objective from the outset. Let me be a bit more specific about how we approach this problem and also on what we get from this approach. So there's going to be essentially three key ingredients that we're going to throw in, right? So the first one is going to be that we're going to think of merchants as being financially constrained, right? So the reason we want to have this is because if you don't have financial constraints, then the decision for these merchants to become active on the platform is completely disconnected from their access to lending. Okay, they're going to be able, if they can borrow frictionlessly, then they're just going to be able to join and become active on the platform if essentially whatever business they have generates a positive economic value. So it makes sense. It makes sense to think about how the platform might want to relax financial constraint to the extent that these financial constraints are binding. So that's the first ingredient we have. The second ingredient we have is, so I mentioned this a little bit in the motivation, is this question of monitoring, right? So as you'll see, the platform is going to have an ability to monitor borrowers, and that's going to be important in shaping how exactly the platform is going to want to provide credit and why the platform wants to provide credit. Let me just insist on one thing, which is we want to be agnostic about whether these platforms are more or less efficient than the banking system. And so as you'll see in the model, we're not going to assume that necessarily platforms are better than banks or worse, right? We're going to look for both, essentially. And that's, again, because our focus is not so much on this efficiency explanation that I mentioned earlier. It's more about the incentive side. The last part, which is important, and not sure I'm going to have time to really delve into it, but the fact that the platform has market power is going to drive our results in the sense that it's going to drive the way the platform is going to price. And then why is it that having credits is something which is useful for the platform in addition to the price? So that's what those are the ingredients. And let me just give you a preview of what we think are the most interesting results that we get from this model. What we find is that the platform may provide credits even with inferior monitoring technology relative to banks. So again, this is not to say that these platforms necessarily have an inferior technology. It's just to highlight the fact that there's an additional incentive for these platforms to enter. It's not just that they're more or less efficient, it's that it gives them an extra benefit that banks are not able to grab. The second results we're going to get is this notion of segmentation, right? So as you'll see, what the platform is going to do, and that's actually in line with empirical evidence, is really target credits to those merchants who are more financially constrained. Okay, so you're going to end up with a market in which the less financially constrained merchants will still turn to the traditional banks, and the more financially constrained merchants are going to turn to the platform. There's a related question, which is, so very often when we think about this question of fintech, big tech, and their role in the credit markets, in terms of regulation and welfare, one important question is, to what extent is the credit that these new players provide? To what extent is this a substitute for credit that would have been provided by the traditional financial sector anyway? And to what extent is this credit, which is kind of a complement, which expands the mass of firms or borrowers more generally that have access to credit. Obviously, the case for wealth enhancing entry of these new players is stronger if you can show that this complement, if you can show this notion of financial inclusion. And what we'll show in the model is that you have both, right? So this fintech firm or this big tech platform, sorry, when it enters, is going to actually grab market share from banks, but also going to allow merchants that would not be able to borrow from banks to borrow from the platform. Okay. And the last point we make, which again, I'm not sure I'm going to have time to really show you how in detail how this works, is that this notion of market power is important, right? So if you have competition, if the platform faces competition in its core business, it's actually going to affect how it's going to behave in the credit market. So you have these linkages between the market power, the competitive position of the platform in this core business, and how it's going to behave on the credit markets. Okay, let me be very quick on the literature. So what we do, I mean, for those of you who are interested in theory, what we do, literally speaking, is we take two models off the shelf and we combine them. So that's the extent of our creativity. We're just really combining two strands of literature, if you want. The hope is that, of course, when you combine them, you get a bit more than what you get, just the addition of the two. There is some interaction, and so I'll try to convince you that this interaction is actually meaningful. So what we do is we take a model by Luohan Webinar, which is kind of one of the canonical model of platforms. And we combine it with another of Tirol's paper on from 1997, which is you can think of also as being one of the canonical model of corporate finance. So how do you raise funding when you're financially constrained? The only connection I want to make to, I mean, of course, there are other papers on big tech I mentioned and credit, I mentioned them earlier. There's just one connection I like to make, which is a connection to a literature on trade credits. You'll see that some aspects of what we do, they have this flavor of trade credit. The idea that maybe, if I'm a buyer, maybe, or if I'm a seller, maybe I want to provide credit to whoever is buying from me, or whoever is buying from me, or whoever I'm selling to. Okay, let me switch to the model. So I'm going to give you, so in this presentation, I'm actually not going to show that nothing really formal. I'll try to convey intuition more through graphs, and you'll find if you like the more formal way, you'll find it in the paper. But I'll try to convey economic intuitions rather than technicalities. So let me start with the platform side, right? So as I was saying earlier, what we're doing is really combining a model of platform with a model of corporate finance, essentially. Okay. So this is Rocher-Tirol. So what I'm really describing in this very standard like workforce model of platforms. So it works in the following way. So you have a monopoly platform in the middle. What this monopoly platform is doing is connecting merchants and consumers. Okay. So how does it work exactly? Well, first of all, when a merchant and the consumers are connected, that costs something to the platform, right? So anytime there's a connection which is made, or I should say, in order for this connection to happen, the platform has to pay a cost. Okay. And then this connection has a benefit for merchants and it has a benefit for consumers, right? There's some heterogeneity. So some merchants are going to value these connections more than others. Some consumers are going to value these connections also more than others. And that's just going to create kind of a demand on both sides of this platform. Okay. Something I should say is that, so in this model, what's going to happen is that every consumer is going to meet every merchant is going to meet every consumer. It's not critical, but just formally, this is how it's going to be working. So what are the decisions that the platform needs to make? Essentially, it's a pricing decision, right? So it's a two-sided market, right? So as a platform, you actually serving two sides, and so you can potentially price on both sides, right? So you can charge a price to merchants, essentially every time they connect with a consumer. You can also charge a price to consumers every time they connect with a merchant, okay? Just to be clear, so I mean, this model was initially when this literature on two-sided market started, that was the key question, right? So the reason why it started here in Toulouse is because actually many of these businesses that had the kind of this platform structure, and it came initially from the credit card industry, they didn't really have a sense of how to price. There wasn't really a model that was telling them how to price, where you're in a situation like this where you can price on both sides. Okay, so these models have been designed in some sense to really deal with this question of pricing. Second thing to just keep in mind is that this price could potentially be negative, right? So it doesn't have to be positive. So that's Rocher-Tirole, just in a graphical way. So what we do is, again, we take this model off the shelf and we make just one small modification. All right. So what we're going to say is that merchants, every time they meet with the consumer, they get a profit from this, which is this VM. And so this VM is going to be fixed. Before there was a distribution, there was heterogeneity in that dimension. Here we're going to take it fixed. The reason we take it fixed is because you're going to introduce heterogeneity along a different dimension, which is this financial constraint. All right, so we're going to assume that these merchants are financially constrained. So what I'm going to describe next is how we model this financial constraint. And this is kind of the second piece where we're combining. That's kind of the Armstrong-Tirole model. And again, I just want to insist on the fact that we're essentially taking this model as it is. We're not plugging it into this platform model. So how does the Armstrong-Tirole model works? So we're going to have a consumer of merchants, and they're going to be indexed by A. So A is an important quantity here, and you can think of it as being either the initial wealth of this merchant, so how much this merchant can invest, or alternatively, you can think about it as being the amount of collateral that this merchant has and that he could use potentially in order to borrow. Okay. So there's going to be a range from 0 to some maximum. And so the idea is that if your A is really low, you have low initial wealth or alternatively low collateral. So it's going to be really difficult for you to borrow, right? While if you have a very high A, you have a lot of collateral, so it's going to be easier for you to borrow. Okay. Why does this even matter, the amount of collateral you have? It matters because there's a friction, right? So if you want to have a financial constraint, you need a friction. And the friction that you have in Armstrong-Tirole is a more hazard friction, right? So what's going to happen is that these merchants, in order to start selling, they're going to need an investment, right? So they need to sink a certain amount of money. And that amount, if it's smaller than the amount of money that they have, means that they're going to need an external funding. More hazard is because essentially the way these merchants are going to behave is going to affect the likelihood that they get this VM here, this profit per trade, which is the reason why they might want to sell on the platform in the first place. Okay. So the way it's modeled in Armstrong-Tirole is to say you have essentially three choices. You can pick a good project, okay? You can behave. And if you behave, you're going to be very likely to succeed. So you're going to be very likely to be able to set up your shop and start, generating profits from selling to consumers. Alternatively, you can choose a bad project. All right, so a bad project, the bad side of this is that you get a smaller probability of being able to start selling. But there's a good side, which is you get a private benefit, okay? Because you have access to this funding, you're going to be able to get something which is your own, and that's the bank or whoever is lending to you is not going to be able to grab. And then there's a third project. So that third project is important on structural because this is how the kind of the monitoring part is going to come in. So this bad project or very bad projects is very similar to the bad project, lowercase, in the sense that it also results in a low probability of success. But it's even more tempting in some sense, right? So it creates an even better and even higher private benefit. Okay. So you might wonder why you need 2 and 3 or not just having good project and bad projects. So I'm going to tell you in a second why this is important. Okay. So the way it's going to be working is that so these merchants are going to apply for a loan. If they get this loan, they're going to have to pick a type of project. Depending on the type of project they get, they're going to generate a certain cash flow. Okay. Okay. So the last piece of this, and then I'll be done with the description of the model and try to show you a bit how how the economic mechanisms work. Is I'm going to assume that there's a competitive banking system, right? So the reason we want this banking system to be competitive is because we don't want the effects that we are going to get in the model to be driven by the fact that you have imperfect competition in the banking system. I think we understand that if there's imperfect competition among banks, then that's kind of a natural incentive for the platform to come in because merchants face a cost of credit which is too high if competition is not, fierce enough. So again, this is not saying that it's not happening in reality. We just want to make sure that we isolate just one effect. So we're getting rid of this imperfection by assuming that so banks are going to compete perfectly, right? So this is not a world in which credit is costly per se. This is just a world in which you have financial constraints. So these banks are going to be very happy to provide funding to merchants. But of course, they need to break even. They need to at least recover in expectation the amount of money they're lending. Okay. Second bit, which is important, is so I mentioned that monitoring was an important aspect of what we do here. And so monitoring comes in this unstructured model in the following way. So if you're the lender and you monitor, it's going to cost you something. So it's really capturing this idea that you're going to have to devote resources to making sure that your borrower, behaves in a certain way. So this is going to be this gamma B for the bank. That's the cost of monitoring. Later on, when we'll be talking about lending by the platform, that platform is also going to have a monitoring cost gamma P. When I was saying earlier, we don't really take a stance on which is more efficient. What I meant is that we don't assume that gamma B is necessarily higher or lower than gamma P. What is the benefit of monitoring? The benefit of monitoring is that you can prevent the merchants from picking these really bad projects. Okay, so essentially, if you do monitor, you're going to take this option number 3 off the table, right? So what this is going to be doing is that intuitively that it's going to relax the financing constraints of the merchants. Okay, so with this, I'm done with kind of the description of the model, so how we think about this problem. And so now I'm going to try to show you, how the analysis. So a good benchmark, a good way to understand how things are going to be working is to say, okay, let's take, platform credit off the table for the moment. All right, so let's think of a world in which you only have bank credit. Okay, so let's suppose that for exogenous reasons, the platform is not able to lend. So what you're going to get then is something which is actually almost straight away from the unstructured model, which is that, these merchants which are indexed by A. So remember, A is the tightness of your financial constraints. So sorry, it's the opposite. It's like how loose is your financial constraint. So if you have a high A, you have very loose financial constraints. You have a small A, you have very tight financial constraints. So what's going to happen in this model is that you're going to partition these merchants into three different types, essentially, right? So at the very bottom, if you have very little collateral, you're not going to be able to borrow. And the reason here is because the moral hazard problem is too strong, right? So because you have very low collateral, you have very little skin in the game, if you want. Because you have very little skin in the game, you have very little incentives to behave. And if you have very little incentives to behave, then the lender is not going to want to lend to you. Now, if your collateral is a little bit higher, you're going to be able to borrow. But the problem is that the lender is going to have to monitor you, right? Because your collateral is a bit higher, but you still have, in some sense, not enough incentives to behave if there's no monitoring. If you can pick from any of these three projects, right? So you would not pick 2 over 1, but you would pick number 3. Okay. So what that means is that you will have access to the credit markets, but it's going to be expensive. So what I'm showing you here is the surplus that merchants get. And this surplus here is going to be lower in this intermediate region. And that's just because, the bankers have to recoup the cost of monitoring. So they still make zero profit, but, monitoring is costly. And because monitoring is costly, this is going to be passed through to merchants. Okay. And finally, you have a last region in which, there you have actually a lot of collateral, you have a lot of skin in the game when you borrow. And so there the bank is going to be confident that you're going to behave. It's actually not going to even monitor you. And so there you not only do you have access to credits, but also this credit is going to be cheaper. Okay. So again, I want to highlight that this is a really standard result that you get from Armstrong Tirol. The difference, so the way in which a model is going to give you already like an additional insight is that, where exactly these boundaries are is going to depend on the pricing policy of the platform. Okay. So imagine, for instance, that the platform decides to increase either the fee it charges to merchants or the fee it charges to consumers, right? In that sense, if the platform does this, it's going to move these boundaries, both of them, towards the right. So it's going to tighten the financial constraints of merchants. Why is it the case? Because so think of the case where the platform is increasing the price it charges on the platform to merchants. What that means is that the profitability of merchants goes down. If the profitability of merchant goes down, it's going to make it more difficult for them to borrow. Indirectly, the same would happen if the platform was increasing the price for consumers. Because what's going to happen is if the platform increases the price to consumers, fewer consumers are going to join the platform, which means that merchants are going to have a lower income, which means they're going to be more financially constrained. So at this stage, where you can see the link between these two models is that, yes, that you have these financial constraints, but the severity of these financial constraints depends on, the pricing policy of the platform. So how the platform is pricing on both sides. Okay. So let me be quick on, so this was what happens on the merchant side. On the consumer side of the platform, this is very standard. So you simply have essentially a demand function. So let me be quick on this. I mean, there's nothing really new. And so what you get in the end, so I said I wouldn't show you equations, but in some sense, the only thing you should get from this slide is that, we can solve for this equilibrium. So we can find the optimal price that the platform is going to charge to consumers. Again, this price could potentially be negative. We can find the optimal price that the platform is going to charge to merchants. And you don't really have to remember anything from these kind of formulas, except from the fact that, we're going to take these two prices as a benchmark, right? So the way we're going to think about this problem is this is what would happen absent big tech credits. And so this is going to be our reference points, right? So when now I'm going to move to the case where the platform can provide credits, and I'm essentially going to compare what happens in that world to this benchmark in which the big tech platform is not active, right? So this is useful only as a reference point. And so, when I'll make statements later on, the effect of big tech credits, it's going to be relative to what we find in this benchmark case. So let me move on to platform credits. So now I'm kind of removing these constraints that the platform cannot provide credits. Now the platform can also come in and compete with banks. So the platform compete with banks, just as a reminder, I mentioned this already, but just because it's going to turn out to be important. So banks have this monitoring technology. The platform also has this monitoring technology, right? And again, for the moment, I'm not saying anything about whether gamma P versus gamma B. Is the bank more efficient than the platform, less efficient? Again, for the moment, I'm not going to leave this open. Okay, so let me try to walk you through kind of the reasoning we went through when we kind of looked at this model. Okay, so the first result, so I mentioned earlier, like in my takeaways, that one of the results we get is this segmentation result, that the platform doesn't want to lend to kind of these guys, these merchants who have a lot of collateral, is going to focus on those guys who are more financially constrained. Okay, so it's just for you to get a sense of why is this happening. So the first result we show is that if I'm a platform, I can't really benefit from offering a contract in which I don't need to monitor. Okay, so let me try to give you a sense for why that's the case. So suppose that I do offer a contract which does not require monitoring. Okay, I'm still competing with banks, right? So if I'm competing with banks, what that means is that I have to improve on the offer that these banks are making, right? So put differently, if you think of this as being the surplus of merchants, right? So kind of the other side of the market, I'm going to have to leave a higher surplus to merchants, okay? And so I can do this, right? But the problem is there's nothing in it for me, right? Because I'm not really changing the total. What I care about is, how many merchants join my platform and start selling. And, if I just slightly improve upon what the banking system is doing, because I'm actually targeting these guys, right? I'm not going to be able to really, this is going to be costly for me. I'm actually offering a contract, which is more advantageous than what banks offer. And so, which means the banks have, so the banking sector is competitive. So banks are making zero profit. So here I'm making negative profits, and there's no side effects. There's no there's no potential. There's no positive spillover effect on my business. Okay. Now you might say, well, okay, but that's because to some extent your offer is not attractive enough, right? So what you need to do is you need to lower these low collateral requirements enough so that you actually expand your market. So you could do this, right? So you could lower the collateral requirements a lot, okay? So that now you start expanding the mass of merchants which are going to join the platform. The problem is that if you do this, because you have very low collateral, you are going to have to leave a lot of surplus to merchants, right? Because if you don't leave them all this surplus, they're not going to behave. Remember, they need this kind of skin in the game. They need enough of a share of the profits so that they behave. And so if they have very little investment in the project, but a very high share of the profits, this is going to be very, very costly for the platform. Okay. And so the platform is not going to want to do this for the simple reason that there's a much, if that's what you want to do, so if what you want is to include all these merchants all the way to this kind of calligraphic A, there's a much more efficient way to do it, which is you can just lower the price, right? So if you lower the price you charge to merchants and you don't land, you're going to actually get exactly the same outcome in terms of how many merchants you onboard, but you're not going to have to give up all this surplus. And so this goes to this idea that, why would you need to offer credits as a way to manage how many merchants you attract when you already have an instrument to do this, which is the price? Okay. So, if you want, so this is essentially saying if you want to understand why you might have as a platform an incentive to provide credit, it has to be something that you cannot just achieve with the price that you charge on the platform. It has to be something else. So that something else is, so this is essentially what I'm saying here, right? So, yeah.
Yeah, so I'm just curious, like how to think about the bundling in your setup. So in many of the big tech settings, so probably they gave very cheap services, for example, lower fee in the example. Well, they also offer some bundled like credit services. Well, they provide credit service, but they bundled it with lower
Yeah.
prices and so on. So basically, they're offering them at the same time. And here it seems like the take up of this credit from either the banks and big tech is kind of independent. So basically, they can take the bank's credit while still using the platform service. So there's no bundling in the setup.
Okay, so can I just maybe, so yeah, so that's a very valid point in the context of model. Can I just maybe postpone the answer to this just for a second? Because essentially what I'm going to be showing you is that in some sense what we get as the kind of so to be clear, so this is not going to happen, right? So the platform is not going to offer credit that does not require monitoring, but it will offer credit that requires monitoring. And one way we can think about how the platform is doing this is exactly as like bundling, right? So there are two ways to think about the results we're going to get. One is to say, so there is no bundling, but then what the platform is doing is actually offering credit which is cheaper than what the borrower could get from the banking system. The other way to think about it is to say, well, the platform is offering a competitive terms of credit, but it's actually bundling this with lower fees on the platform, which I think is exactly what you're saying. So in some sense, we could get this as an equilibrium out.
Excuse me.
Yeah.
Hi, Matt.
Hi.
May I ask a question?
Sure.
So I would think in the essence of finance, any lending should have a monitoring function, right? So my point is that it's not just about platforms, but I think banks are the same. But my question here is, in your view, in essence, is there any difference between a bank and a platform that provides financial service? What exactly is that?
Right. So thanks. I think that's very actually a very useful question to clarify. So I'm fully on board with what you're saying, right? So in ours, just to speak about what we do, in our setting, both banks and the platform actually do monitor, right? So at least they have the ability to do so, right? So they might not do it if, the collateral which is posted is high enough, in which case, they might think that, this monitoring in the model, this monitoring is not even necessary. But our starting point was really to say,
so my point is that it's not about intention, it's really about ability.
Yeah. So the ability, so they both have the ability.
Right. Well,
So
there's different type of ability.
Yeah. Precisely, I think that's our point, right? So we didn't want the difference between the banks and the platform to be driven by different monitoring abilities, even though, you know, that might be the case in practice, right? So even, I mean, I don't have like a really strong opinion on this. You know, are banks better at monitoring than platforms? I'm not sure. I think it probably depends on which type of loans and which type of borrowers. But here, what we're really trying to look at is, you know, what happens if, so let's say they have exactly the same ability to monitor. We really want to focus on incentives, right? So is it the case that as a platform, I get a slightly different payoff from lending than a bank would? Okay, so that's, so which I think is along the lines of what you were pointing out.
Hi, Matt, how are you? This
Hey.
Ian. Hey, how are you? Good to see you. Yeah, this is like a kind of point of question clustering. I also want to ask a question. Overall, I like your model. It's very elegant. You make it very transparent. So I have a different thought. So now you focus on the kind of moral hazard kind of perspective. Initially, before you talk about this, when you talk about the difference between fintech and a big tech, you say fintech is a kind of a pure player and big tech is a kind of platform. So when you try to move on, and initially I thought you try to argue from a kind of adverse selection perspective. I think those big tech firms, they might have a lot of data, a lot of interaction with the merchant or consumers. And so they can better screen the kind of the borrowers. So that will be a totally different modeling. So here you focus on ex post. So I initially thought about ex ante might also be very relevant. So I want to see your perspective. So why you model from this kind of moral hazard perspective instead of kind of screening the adverse selection perspective.
Okay, so I think it's a bit of a matter of opinion. So you're right. So there could be differences in abilities to screen. So one reason we don't really look at it here is in part because, I mean, there are papers which have looked at this and said, okay, suppose that for some reason the big tech platform has a better ability to screen than banks, then, you know, what happens in that case? And so, you know, there are actually interesting effects. So on the question of, is it the case that big tech platforms are better able, I mean, in practice, better able to screen than banks? I'm not entirely sure because banks also have lots of data, and all banks, at least some of them, also have the ability to, you know, build kind of.
Yeah, I'm not arguing they are better. This is similar at what you do now. So they can probably also can have, yeah, both of them have ability. They just are bundling.
Yeah, so but I think on your question of why is it that we focus on moral hazard, I think there is actually at least stylized evidence that this enforcement ability might be one important dimension along which, you know, platforms have at least some skills, some ability, right? So this idea, so at least in the design of some of those credits offers, you do see cases where, you know, the enforcement ability, so the credit is designed in such a way that the platform to some extent grabs directly your revenue, because you're actually, in order to generate revenue, you have to go to the platform. And so the platform has an ability to both see what you're doing, you know, how well you're doing, so how much are you selling, what are your reviews, are consumers satisfied or not? So, you know, the ability to potentially anticipate problems, but also just an ability to just directly grab some of the cash flow that you generate as part of the contract. And so what we wanted to capture is this notion that, you know, if you do have this moral hazard problem, you know, it seems like this monitoring capacity is something which is important for platforms. And in fact, in the model, as I'll show you in a second, this monitoring ability is very important. If we didn't have it, so we don't need the platforms to be better than the bank at monitoring, but we need the platform to have this monitoring ability, right? And that's going to drive some of the results. Let me perhaps show you just, because I just want to, I only have 10 minutes left. So let me just show you perhaps, because I want to get to the main result and the intuition. I think the rest of the paper, you can get the
Okay, great.
there are
Yeah.
more bells and whistles, and I'm sure you can, especially Luohan, I'm sure
Hey,
I can understand them very well. Okay, so let me
so
not show you what's going. Sorry, there was another question. No, okay. Okay, so let me just show you how. So the first thing I wanted to convince you of, at least in the context of my model.
discuss this a little bit further.
Sorry. Okay. So the thing I wanted to convince you of is that what the platform is really going to be focusing on is this segment of credit with monitoring. Okay. So what's going to happen there is that, so if you're the platform and you offer credit that does require monitoring, okay, so why would you do this? Again, the intuition is because if you do this, you're going to be able to expand potentially the mass of merchants which are going to become active on your platform. And that's profitable because you're going to get fees from these merchants, right? Now, the problem is that you can only do this by relaxing these collateral constraints. Okay, and so if you relax this collateral constraint just as before, what's going to happen is you're going to have to leave more surplus to these merchants, right? Because otherwise, again, they're not going to behave, right? So they're going to be subject to this moral hazard problem. Okay. But the thing which is very important here and differs from what I showed you earlier is that, so to some extent, what you're doing here is that you're giving an extra amount of surplus to these merchants, but you're not giving it to all merchants. You're only giving it to those merchants which are constrained, okay? And that's the key intuition in the model, right? So then we do more things, but at the very core, the key intuition in the model is an intuition of price discrimination, okay? So why is it that you use credit? It's because by targeting those merchants which are more financially constrained, you're going to be able, essentially, it's equivalent to lowering your price, but you lower your price only for those merchants, okay? So it's not just the marginal merchants. You're not going to be able to target precisely the marginal. That's what you would love to do, but in our model, it's not possible. But still, you're going to be able to lower your price without affecting, for those more financially constrained merchants, without lowering your price for less financially constrained merchants. And that, I think, goes back to, I think, Shumiao, your comment earlier on how to think about these offers. This, in fact, is entirely equivalent to providing credits at the same terms as the banks. So breaking even on your credit contract, but then lowering your fees, but you're lowering your fees only for those merchants who take your credit contracts, not for the others. And that achieves exactly the same idea of price discrimination. So that's the key idea in this model. So that's what you're going to be doing. So then it's a very standard idea, right? So in IO, if you have an ability to price discriminate, typically what you're going to do is you're going to be able to expand your markets. That's the first step. And then the second step is, let me skip this, is that you're actually going also to increase your price on the less financially constrained merchants. You're going to essentially increase your price. And so these guys are going to have actually lower surplus. So it's going to be a combination of expanding the range of merchants that are actually going to have access to credits, and being able to extract more surplus overall. So it's a combination of things. So I only have 5 minutes left. So let me just perhaps quickly tell you a few more things that we do with this. So from this analysis, for instance, so again, we get this notion of segmentation, the fact that the platform is going to focus on these more financially constrained merchants. We get this notion of both complement and substitute. So the platform will capture some of the market that was previously held by banks, but is also providing more credits to then, what would happen if you just had the bank. In terms of welfare, so of course, one of the objectives when you think about these models is that you can do actually a welfare analysis. And here, you have contrasting effects, right? So of course, the platform is going to be better off, otherwise it would not do it. Okay, so that's kind of straightforward. If you're a more constrained merchant, you're gonna be better off, right? So for two reasons. One is that you might actually have access to credits when you did not have access to credits before, when the platform was not there. And second is, idea is even if you did have access to credit before, now you're going to have access credit under better terms, right? Consumers are better off, so I'm focused a lot on the merchant side, but remember there's consumers on the other side, so that's something we exploit more in the last part of the paper. Consumers are better off in this case. Why? Because you have more merchants, right? So you onboard, so more merchants have access to credits, therefore more merchants sell on the platform. And because you have this kind of cross-sell externalities, that means consumers are actually also better off, right? So one way to think about it is they have more choice, they have more options, okay? So the only ones which are, for now, actually worse off are the kind of the less financially constrained merchants, right? Because for them, this price discrimination works against them. One of the things we show, again, so I won't have time to show you this, is that this is actually true in the version of the model I've shown you, and just because you don't have, we're shutting down some of the cross-site network effects. When we allow these cross-site network effects to work, this result can be reversed, right? And so an intuition is that even though the price that these merchants face is higher, what's going to happen is there's financial inclusion, so there are more merchants that join the platform. Because there are more merchants that join the platform, this is where these cross-sell network effects are important. You're going to have more consumers on the other side. And if you have more consumers on the other side, the profit of all merchants might go up, despite the fact that, per transaction, they can be charged a higher price, right? So there is an intuition there, okay? Okay, so we talk about welfare. Again, we talk about this cross-sell network effects. If you're interested, at the really back end of the paper, there's a discussion on market power, right? So in the model I've shown you, this is really just one monopoly platform. Why is this important? Because that's the reason why you can have price discrimination, right? Because you're not constrained to price at marginal cost. So one of the things we do is we say, okay, what happens if there's some limitations to this market power, right? So essentially, if merchants and consumers have outside options, they can trade off platform. That's going to limit the ability of the platform to extract surplus. In that case, what happens to credits? Okay, so again, I'm not going to walk you through this, but if you're interested in these questions, that's something we look at. Okay, so I don't want to go overboard, so let me just conclude. So what you should remember from this presentation is what we try to do here is really this notion of, I think, insist on the fact it's important to jointly think about the core business of the platform and the lending business if we really want to understand why these platforms have an incentive to enter the credit market. This is what we do. It's a model that jointly thinks about platform pricing and credit offerings, right? Main results we get, let me repeat this one last time, is so platforms benefit from entering the credit market because of this price discrimination motive. And so they're going to do it potentially even if they're not as good as banks at monitoring. Platforms credit benefits more constrained merchants. So the welfare effect for less financially constrained merchants depends on the strength of these cross-site network effects. And the last point I mentioned is, again, this notion of complementarity, substitutability. Essentially, we get both. But one message here is that it is something which is going to create on the merchant side for financial inclusion. You're going to be able to expand the market, as is actually the case anytime you have a monopoly with the ability to price discriminate. All right. Again, I'm happy to answer questions if there are more questions left, but I also didn't want to hold up everyone, so let me stop here.
Hi, Matt. So I would like to. So firstly, I like the conclusion or insight of the paper, but I just want to add more reflection on this.
Okay.
So basically, I think let's think about what's the nature of fintech on the lending side. Okay, let's not talk about other side. But basically, finance is a information-based business. To me, I was a strategy officer for Ant Group, so I've been for a while. So I think because this is the finance in essence is the information-based business, and to me, banks do not have any information advantage, but what it has is that it has deposits, cheap deposits. The cost of funding is extremely low. But then for the fintech, it has information advantage, but it doesn't have a funding advantage. So for the fintech, naturally, to position itself, it's going to help the financially constrained firms. What financial constrained firms, in essence, is because of the asymmetric information monitoring cost, stuff like that. Mm-hmm. So banks cannot provide adequate service to them because banks have information advantage. But then platforms, they have information, but the funding cost is low. It is high. But for them, naturally, to position themselves, they should target financially constrained firms because that's the group that banks do not provide a good service. So, but then the cost for the funding cost for the for the platforms is higher. So it's naturally for them to position themselves is to differentiate from the banks. So that's my understanding of the nature of the fintech. But I think the conclusion here is that because of the information advantage, fintechs, they're better positioned for the financially constrained firms, right? Because that's the outside of the reach of the banks. That's the whole thing. Now, if the financially constrained fintech firms, if they have the cost of the lending as low as the banks, I don't think there's a space for the banks. Let me give you one concrete example. For example, for Ant Group, we have a banking license, but the banking license, the problem is that you cannot have deposits. So that's how the banks works with the regulators to constrain you, make sure that your funding cost is high. So you can only do things that banks cannot do. But that's the dynamic or ecosystem of this whole thing. But anyway, I'm just providing some comments. I think the scholars, let's think about the nature of these things. That to me, that's the essence of this of fintech. The relative versus the banks. But anyway, I like the conclusions. I'm just trying to make some comments about the essence of the fintech versus banks.
Yeah, no, so I fully agree with everything you said, from cost of funding to potentially having an informational advantage. I mean, my sense would be this informational advantage, as you mentioned, is particularly strong for potential borrowers who are not included in or at the margin of the financial systems, right? So for those who are already there, let's say already banked, for instance, perhaps it's a bit less clear, whether banks or fintechs have a better informational advantage. But for those at the margin, I mean, I take your point. I think again, so what we are trying to do here is not to say that those things are not important, right? So we're not saying that fintechs don't have, like, for some reason, some kind of superior information or monitoring abilities. We're just trying to say, okay, so in addition to all of this, could it be the case that the fact that you have this core business changes a bit the way you're going to also allocate credits, right? So that's, in some sense, I see this as being a complement to these more information-based reasons, which I'm sure are important. it's not rather than, you know, like a competing explanation, right? So we're just looking at this from a different angle. But again, all points are well taken, and thanks for the comments.
Right. So, but I guess my point is that fintech and banks, they are different species. They have different strengths. Banks have strengths of cost of funding, and the fintech has strengths in information advantage. That's why they have different customers that provide different service, and they complement with each other. That's my point. I think that's the essence of fintech on the lending side.
Okay. So I agree with that.
Because a lot of times people talk about as if fintech will replace banks or whatever the tension between them. They're different species because they have different advantage. Let's take that and let's model that. And so I think because that's the essence of finance.
I think I think both from a modeling and from a practical standpoint.
Right.
I think where it's difficult to think about this informational advantage, so let's say in a model, for instance, is that, you know, at the end of the day, this informational advantage is endogenous, right? It's not something that falls from the sky. I mean, it turns out that these fintechs or these big techs have an informational advantage for a reason, right? So they managed to get their hands on some kind of data, or they developed kind of technologies which allow them to map this data into credit risk, into like a more precise way than banks. And then the question becomes, okay, so why is it that banks don't do this as well, right? So
well, they're too far away from the real business activities. That's why, because it's too costly for them to do that. For the fintech, they are just embedded in the real business activities. It's just really a natural consequence for them to record what they observe. For the banks, it's not natural because they are too far away from the real business or economic activities. It's too costly for them to do that. That's why that's the case. Yeah.
Yeah, so it could be. I think there's something that, because still, I mean, if you're a bank, you have, you know, there are massive economies of scale as well in doing this, right? In developing this kind of, like if I'm JP Morgan, for instance, I'm pretty sure they do invest in this kind of, you know, big data, machine learning, you name it, kind of technologies.
Well, they don't have data. That's the point. So you can buy it, you can whatever it is, but they are just for the banks. It'd be nice that the resource of the information is also the finance provider, right? But the banks, they are not the information providers or the observers. They have to buy it or they have to acquire it. So that's why it's costly for them. I think the point, I like the paper, is that we really need to think about, for different financial service providers, what's the nature of their advantage, why do they have different values, and why in a healthy financial system in the digital age, why they have different value proposition, and they have different positioning, and so they don't really compete as much to each other. And because they have relative strengths, I think that's the point.
Yeah.
Okay, so thank you, Matthieu, for the insightful and a great presentation, and thank you everyone for participating in the seminar. So that's the end of the webinar.
Thank you.
Thanks, Matthieu.
Thanks a lot.